Hi everyone, thank you so much for joining us today. This is Stanley Dash of TradeStation. Welcome to this month's Spotlight On, or the second for the month. Today's October 21st, 2014, and it's great to have Larry Williams as our guest. Larry joins us from time to time for various web presentations and occasionally live presentations, and it's really always great to have him with us. And I want to thank everyone for joining us today from so many places around the world. We don't always do this, but I'm going to take just a minute of Larry's time to open up the map. And if I do this correctly, I can show this to all of you. I think it will populate right. If the player doesn't work to do this right, then you won't see a map, but maybe you'll see that. So we are logged on from most every continent, and perhaps ships at sea for all I know. And I'm really thrilled that everyone is here, and this is great. And of course, I'm very appreciative of Larry's time to come and spend with us today. Let me close this and let's get down to work. If I didn't close it on yours, there should be a close button there, so you can get that out of the way. A couple of things I want to mention. This will be archived, and we'll put it up on our YouTube to see it through our new TradeStation app, and I won't spend too much time talking about that, but here are the links to get the TradeStation app if you want, and also our YouTube channel. And it will be on our other page. I'll get that link and throw that in as well on our main page. It's all the same feed, so it doesn't matter where you see it, but we'll get this turned around in a couple of days so you'll be able to see the archive. Let's get down to work. Of course, Larry is independent of TradeStation, so please be mindful of the fact that his views on trading in the markets are his own. His views on risk management are his own, and you should always consider the risks on any trade before you put it on. Make sure it's appropriate for you, and make sure that you are prepared to manage any trade appropriately once you do decide to put it on. There's more such information in that important disclosures PDF that I pushed into the chat. That PDF and the other links that I've been throwing at you are all in that documents area at the lower right that I just pointed to. So if you want to reference any of those, you can pop in there and you'll still hear Larry and see the presentation. But if you need to check any information, there are plenty of links in that documents area. All right, there are a few people who need very little introduction, and Larry is one of them. And it's just great having you on today, Larry. I'm just going to mute my microphone, and you can take over. I'll be right here if you need anything, but I will be listening attentively.
Pleasant surprise to see so many people from names from all over the world, so many that I recognize. It's just an amazing honor to have you here today. I just hope I can earn that honor by sharing with you a few of the things that I've learned about trading over the last, well, more than half of a century now. So let's get started. This is going to be an interesting presentation. It's something that I did real time with real people, really live this summer with TradeStation in Chicago, Los Angeles, Fort Lauderdale, Kansas City. So I've had some good feedback on what I'm about to teach you. That'll give you a little bit more insight to it. But the big thing, this is not easy, man. I'll tell you, this is not an easy game of being a successful trader. If you look at investment hedge fund skill, there's been some reports done on hedge fund managers are supposed to be so good. And what it basically said is that good investment performance does not signal more good investment performance. In other words, that old adage that the future is no guarantee, past is no guarantee of the future, is absolutely right. Good performance doesn't mean you'll be good in the future. Bad performance doesn't mean you'll be bad in the future. It's just a tough business. Can we make it a little simpler for ourselves? I think so. But we all know this is not easy, which raises an interesting question about you and about me, about us. Why are we seemingly hardwired to try to beat what, for the most part, can't be beat? Not many people beat the market, so are we just fools rushing in to this thing? I mean, sometimes I stop and I wonder about that. I go, wow, what is this all about? But I think it's a challenge of it. And the challenge for me has been my life passion since I started this in 1962. At one point, I decided I wanted to become more of a systematic trader because I wanted to rely on a system. I figured we could make systems out of the market. Well, we can and we can't, but I'm going to share with you what I've learned from making my systems over the last 53 years. Because I really have learned, I think I know about systems. I've earned the right to be here today. Probably the first person to do a mechanical system commodity way back in the 1960s. So tough to make systems, but here's what I've learned, that there are some things that do hold up. These are some of the important things I've learned. Diversification is a good idea, but patience is a better one. Most people will try to be diversified and be in several different markets or different trading systems. My experience, though, actually is that patience with the system is really important, because systems don't make money every day. They have up moves and down moves, just like the markets themselves. And patience. Diversification actually can be a dangerous tool. This is a big thing, acceptance of the irrational. Yes, this is a repetition for the most part of what I did in Chicago. Acceptance of the irrational. There's just a lot of things that happen in the market just plain goofy. There's no explanation for them. Sometimes gold is up the same day as stocks are up and bonds are up, and it's not supposed to be that way, but it is. And so you just have to accept a lot of irrational activity if you're going to be in the market. Well, if you do get a good system, don't mess with it. And here's a really interesting thing. Buy signals work best in at least my systems. Now, maybe that's because I have a bullish bias, but I don't think so, because I love to sell short. I made my first $1 million in stocks way back in the 1970s on the short side of the marketplace. I love to sell short. But when it comes to these systems, short-term trading systems, my experience is that it's actually easier to find things on the long side and put on, if you want to make systems good, just stop trying to look for sells. I have some pretty good sells, but not nearly as many. They're hard to find. I'm also using a dollar stop in everything I'm going to be talking about today, a fixed dollar stop, or I'll exit on the first profitable opening. Now, there are a lot better ways of doing that exit and the stop, but I want something mechanical that we can all start with as a testing point. Also, my results will vary from years due to data, time frame, stop issues, software, all that kind of stuff. But just be aware that there may be some slight differences. Some of you will try to replicate what I'm showing you. Data differences are huge. We'll talk a little bit more about that. This is how I trade the system. This is important. Internet connections. Here I am in the Virgin Islands, way was removed as almost anybody on that map that we saw. So I don't have really good internet connections here, especially during hurricanes. So I'm on a cloud computer. My mechanical systems are running on a cloud computer, because that way I don't have internet connection problems. I don't have data issue problems. But I do have to make certain that my position sizes are correct. I want to make certain that for whatever my account balance is, I'm trading the correct number of systems, the correct number of positions. So I do have to monitor those, and as I make more money, I increase my position size, and as I decrease in an account, I will decrease the position size. So, and I think this is the way of the future. I think that more of us will be trading on cloud computers because they're just more reliable than our computers at home. So I think that we're going to see that as a big change coming up here. Key point, longs work better than shorts. This is in all markets that I study. Is it due to drift? Well, no, because a lot of markets don't have upside drift to them. More follow through, that could be, or maybe just easier to see. But that certainly has been my experience with these systems. Even in bear markets, this is the equity of a system that we trade, that we've actually had a TradeStation running for a year and a half now, I think. Notice in 2008, that was a big bear market, but look at how profitable the system was on just the long side. So you can see that a cloud computer is a question come in. A cloud computer is a computer that is located maybe in New York City, or they have redundant computers in 4 or 5 different places that just aren't going to go down. So access that computer on my computer. I may lose my internet connection, but these guys have redundancy to the nth degree. So those computers are going to always be there. They have more power, more memory, obviously, than what I have. So I can access that computer. We call it in a cloud computer. Okay, so there are parts of a system. I think we can break down a system that'll help us develop systems and understand them. There are entry rules and there are exit rules. For my entry rules, the things that I found that hold up the best are patterns. There are certain price patterns I've written about in my books over the last quarter of a century that work, continue to work. There are some seasonal patterns that still work, always have worked, and volatility expansion. Basically, a market opens, it's going to expand and move in one direction for most of the day. So an expansion of volatility can be good. And stop loss, well, my exit rules, I'm going to acknowledge I'm wrong, not based on average true range or any of those concepts because they can be too far away. I have time targets and price targets. If I haven't made any money by X period of time, maybe I better get out. If so that would be a time target or price targets. I've reached a profit, I've reached a price point, etc. Then I can get out. This is the value of stops. This is really important. This is a system we actually trade, but we're looking at the system with different stops. Now, we'd all love to have a real close stop to the marketplace. Like this is a $900 stop that you see right here. Doing that with a $900 stop, this system has 70% accuracy, and it makes $83,000. If I take that stop up to a $2,600 stop, my accuracy is 88%, and I make $141,000. So I'm making $60,000 more because I'm giving the market room to fluctuate and move a little bit. I'm not a good enough of a trader that I can buy at the absolute low and the market never looks back from where I buy. My experience is the market may work both sides of where I buy. It'll go up, it'll come down, it'll go up, it'll come down, and then hopefully it takes off. I think for at least my style of trading, and I'm not a day trader, that I want to give the market some flexibility, some room to breathe. That's my dollar stop loss. In the case of the S&P E-minis, a dollar stop loss of somewhere in the $25 to $100 area seems to be ideal. Notice that you get too big in your stop loss. My accuracy stays the same, but now my profits start to go down. So there is a sweet spot, if you will, in terms of stop loss points for all markets. And what's interesting is, as I've traded these systems over the years, for many years now, those stop points are pretty much the same. The stop I'm using for Treasury bonds now is just about the same stop I was using for Treasury bonds in 1984, 1985. The stop for the S&P, though we've gone through different contract sizes, commensurately, about the same dollar amount. So I think those things have actually been very consistent when it comes to stops. So lesson learned, small stops, less accuracy and smaller losses. Larger stops, higher accuracy, larger profits, your bottom line will be higher. Higher average profit per trade and more consecutive wins, but only to a point, as pointed out. Go back and see if we have consecutive wins here. Yeah, with a $2,600 stop, we had 64 consecutive wins in a row. With that $900 stop, the max wins in a row was only 15. So you see, if your stop is real close to the market, you're going to get stopped out a lot. It isn't about them going for your stops. It's just a function of how markets work. Well, this is an interesting one. Time, I think, is our ally. Do we want to hold or do we want to fold? If I'm running this system, we're going to hold for just get out as soon as we can one day. Where 94% of the trades wins. Our average profit per trade, though, is $670. If I wait a little bit longer, look what happens. My average profit per trade goes up as I'm in the trade longer. We got Optimus being in about 2 days. My average profit per trade is almost 30% higher than it was just getting in and getting out essentially the same day. And of course, I make more money. So I like to see a high average profit per trade. These results are from TradeStation, yes. Good question here. On a $2,600 stop, what size would you recommend? Well, obviously, it couldn't be a $10,000 account because you could lose 25% of your money in the first trade. I'm trading $1 million account, so it's a little different for me. But you can trade the small contract of the E-minis if you have a smaller account. Or you could use options, though I'm not an option guy, or maybe you could use ETFs. You'd have to ask somebody else about that. So time is our ally, but only to a point. If we wait too long, then we start to see deterioration. 5 days, we don't make nearly as much money as we do even at the first day, do we? And look at our drawdown. So for short-term traders, you don't want to hold too long, but you do want to hold for a little bit. Now, how about this one? Buying a limit. I don't know about you guys and gals. I'm cheap. I like to go to Costco. I like to get things at a discount, especially when I'm trading, right? Sometimes I get good fills, sometimes bad fills, but I always like to buy below the market. It's just human nature. So I did an interesting test. This is a wake-up call to all of us. If I buy in the opening in this system we're talking about, 93% of the trades win, the average profit per trade is $635. If I buy on the opening minus 10% of yesterday's range, I want to buy a little cheaper, right? I'm going to let the market pull back. Buy in the pullback, I have fewer trades and I make less money. If I wait for 20% pullback from today's opening of yesterday's range, my accuracy is still good, but now I've lost $22,000 I could have made had I bought on that opening. And my average profit per trade is now warbling and drifting and falling away. If I buy the opening minus 50%, in other words, I want to buy at that magic 50% correction, well, look, not so magic, is it? My accuracy goes down. I only make $36,000 and my average profit per trade declines. Now, why is this? This is happening for a very specific reason. Let's see if I can draw this for you. Try to draw your drawing pencil. Let's see if strike. The way markets work is they open here and they run up to here and they come back and close here, something like that, okay? Markets that have big moves don't open here and go up and come back and come up and come down and then do this. That's very rare. Markets, if you look at your charts, you'll see you have an opening here on a big up day and a close up here. In other words, the close is on one end of the range and the opening is on the other end of the range. And we've always known that. I've lectured about this for many years. What we're seeing graphically presented to us in this data is exactly what I talked about. If you're going to have a big up day in the market, you simply don't pull back very much. So waiting for the pullback is basically a loser's game. The market's not going to pull back and you will miss trades. Look at the trades you miss. And of course, you're missing those days that just open by the opening a little bit. Now, boom, away they go to the upside. You miss all those trades. And those tend to be the big money trades. But what if we do the opposite of this? We're going to buy on strength. What if we let the market prove itself? We're afraid to buy in the opening, so if the market moves up, we'll buy it. If it moves up a little bit higher, we'll buy more. Well, look what happens. We buy the opening plus 10%, we don't make as much money. We buy at the opening plus 20%, we make less money and less money. The further we wait for the market to prove itself, the less money we make. So generally speaking, for a swing trader, somebody is trading today and will be out in a couple, 3 days from now, clearly the best price most often in most is going to be getting in at the opening. If you wait for a pullback, you're missing trades. If you wait for the market to rally, you're giving up too much money waiting for that market to rally. When I buy in the opening, I'm actually buying on the afternoon session. So if I have trades tonight in the S&Ps in an hour and 7 minutes from now, I'll be taking action. Actually, I will be taking action. Our TradeStation system went long today, and we'll be getting out of that trade on the opening of the night session. So that's an actual trade that I did in my account. Those who subscribe to it just checking my system right now on it. We'll get out in the opening and take a nice profit. We bought in the opening. We'll get on the opening, and that's a great profit for us. What if there's a big gap on the opening? Well, what if there is? Look at the numbers. What do the numbers tell us? Tell us that we want to be on it. We want to take advantage of that gap. So, Seth, you're a little confused there. The slides aren't updating. What you should be seeing now is the buy on strength slide. The basic point is, really, if the market's going to explode, it's going to go up. You don't want to wait for it to go down. And if you wait for it to go up, you're going to be missing some money and leaving that on your table, on the table. My account size, I'm usually doing 2% of the account value as my risk factor on all of the trades. Still buy on limit side. Well, I'm way, okay, just updated. Yeah, right now we have lessons learned. So the lessons learned is this is not an easy game. If your rule is good to get you in, or your feel the market is good, the opening price on balance is best, or it could be the closing price. But you try to play fancy games, dancing in and out, actually it doesn't seem to be as good. My observation is that this was not true in the pit session markets. And ladies and gentlemen, this is a huge change. We went from pit session markets to electronic markets. Everything changed. There's a good note. Joe, that Joe Cretton. The slides are not updating. Click the blue X in the top right. Select Reload in Browser. Thank you for that. So most of my data goes back to 2002 because that's about when we went into electronic markets. Now I have tested back farther than that, but without a doubt, when we started trading not directly with brokers and pit sessions, the way markets moved changed. You better acknowledge that in your studies of markets. So here's something else at what matters. Pain and pleasure, really, the two driving forces of all of us. Pain to me is drawdown, and that's in time and money, right? So if I'm in a trade for 100 days and make $1, that's painful. If I'm in a trade for 1 day and make $1, that's obviously not quite as painful. So time is one of the functions of pain. Pleasure, of course, is going to make money quickly. And that's how everybody wants to make money, but it isn't always how money is made. But the quicker, obviously, the better. So how does that relate to systems? Well, the time to make an amount of profit. If I can make $300 in 1 day, I would rather do that than 3 days to make $300. So when I evaluate systems, I'm very concerned about my average length of trade, how long I'm in the trade. Here's a system that makes $400 with 80% wins. System B makes $600 with 90% wins. This looks like the better system, right? I mean, I make more money and my accuracy is higher. But let me show you something. If my drawdown is $300 for this system and $150 for this system, clearly this is the better system. So you need to look at how much money you have to put up to make $1. That's a big part of it as well. I'm going to have to step in here and make one comment. I see a lot of people talking about Renko charts and candlestick charts and all these charts, and maybe I'm just old-fashioned. But guys, I've looked at them. I go to Japan once a year and lecture to Japanese people, and there's these other ways of looking at charts can be helpful, but it's real tough to make great mechanical systems out of candlestick charts. I think just open, high, low, close charts are actually the easiest to work with. That's my point on all the various ways of looking at charts. Just the old-fashioned way is pretty darn good. I think more people in Japan use open, high, low charts than use candlestick charts, truth be known. Well, this is a big breakthrough for traders. What happens if you have an exit for tomorrow? Like I have an exit to get out of the S&Ps tonight we bought on the opening today, right? Well, what if I have another buy signal to buy tonight on the opening? That could happen. Do I want to just exit my trade and walk away, or do I want to continue holding the trade? And what I found is you want to take the profit and run. No, you don't want to fold. You're in a position and you get another position, another signal from your system. You want to roll into that new position and ride that trade. And that actually makes quite a bit more money than going from long to flat, even though you have a new signal in the marketplace. Well, in a moment, I'm going to explain patterns you can trade with, but I thought I would update you with my 2014 forecast. This is a forecast that I did in last year, in 2013. We set it out to all my readers. This is what we had forecasted happen for the year, the red line. Okay, and we can update that. This is just a while ago when I was doing this on the mainland for TradeStation users. This is what our forecast was. Well, you can see where we are now. we've had this big up move that we forecast for the year. Now we come in this down move. It looks like around the end of October, somewhere in this time period, is we're getting close to a pretty significant low in the marketplace. Linda, I don't know if you're talking about the basic and the premise of the forecast. Is that your question? The forecast is based on an average of cycles that have gone on in the past. I've been making these yearly forecasts every year for quite some time, and they've been pretty helpful. They're not perfect, nothing is, but they're a pretty good roadmap of what to expect in the marketplace. Here's a longer range one. This is a cycle forecast that's been really good, pointing out about every year and a half significant lows in the market. And the next significant low in the market on this pattern that started back here in 2008 and 2009, the low, the low, the low. I want to write this down, August 14, 2015. Next August, I would expect the market to again have a significant up move starting in it and to the upside. Here was our crude oil forecast for the year. You can see this was done in the middle of the year. We expected, obviously, for the middle of the year on down, crude oil prices to come down. Well, that's probably been the leading example of the biggest bear market other than the grains has been crude oil. So we can see again that these forecasts can have value. I don't use the 60-year cycle. You know, that's a cycle, I think, Jupiter or Saturn or one of the planets or something. I've not found it to be particularly reliable. It doesn't hold up over a long time period. So here's crude oil. This is the crude oil forecast updated. You can see what our forecast is for crude oil coming down into at least December. Can I slow slide 27 again? Sure. There's 27. So that's a long range cycle, about a year and a half cycle, and that triggers in August this coming year. I would expect another significant up move to begin in the market. Not necessarily that we'll have a low, but that an up move begins then. Here's the euro currency. You can see our forecast has also been for that to come down until most of the rest of this year. And here's the euro currency. You can see what had actually happened. And we'll go back to this was the forecast that we were looking for. We said, we should start to go down about June, July of this year. That was forecast last year, and here's June, July, and that's where the big decline began. It's a question. If you have a long position in the SP Mini for June contract, will that be rolled into the September contract? Yeah, you would roll that into the September contract. Here's our coffee forecast. The coffee should bottom about here, pull up, dip. And now we look for coffee to start to have a rally starting in October. I'll let you guys and gals look at what's happened in the coffee market. So I'm trying to speak of a real close to significant buy-in meal. This is another one of those long-range cycles in the market. You see we had a nice up move begin here, one began here, nice up move began there and here and back here. And we have one scheduled for October 2014. So here we are right here, right now. I would look for an opportunity to buy soybean meal based on these longer term cycles. Gold forecast when we did this last month was the gold price should go higher. I pay a lot of attention to the commitment to trader report. That's the red line of the commercials. They'd started to do some buying, so we're looking for gold to go higher. Unfortunately, that's been accurate for us. This is the forecast for gold. My natural cycle forecast, we should hit a little low in here and start up in the October time period. So that would be my view for gold for the rest of the year. I saw some people were asking questions about precious metals. Basically, the cycles are now to the upside. Of course, when we made this chart, made this forecast, it looked like gold was going to fall apart, didn't it? But we had this view back then. What should be happening? Also, a 4-year cycle, this is what you're looking at now. You good big gold bug guys, 4-year cycle has been huge in this gold market. Big up move begins on about a 4-year basis in gold, and that's where we are now. So I would expect us to start to see not just a little rally in here, but we're thinking about a pretty good rally in the market based on the 4-year cycle. If you want to do a lot of long-term cyclical work with gold, it's 4 years. Okay, let's have some fun. Let's go look at some systems and daily stuff you can take home and start trading tomorrow. That's what you want, right? There are only 4 ways you can lose money in the market. That's it. Isn't that nice to know? Today's range is going to be an outside day. In other words, today's high is above yesterday's high, below yesterday's low. Or today can be a down range. Today's high is below yesterday's high and today's low is lower than yesterday's low. Or we can have an up range. We can have a higher high and a higher low, or we can have an inside bar. Today's range is totally within inside yesterday's range. There are 4 possibilities that can happen. There's nothing else that can take place in the market. Knowing that, we can now start to construct and do some tests to find out if these patterns mean anything. Christopher, my S&P forecast is we're close to a significant low. I hope that sums it up for you enough. And we've been looking at that since January. We've talked, well, since last December with my forecast buyers about what's going to happen, that there's going to be a great buying opportunity in October. And, well, ladies and gentlemen, let you judge that for yourself, huh? 2015 forecast is almost done, by the way. That's going to be a great year for us. Okay, here's the starting point to a trade. If we have an inside day with a minus close, I want to buy tomorrow. That's what I'm going to look for. I'm going to look at this inside day. That's a day that was within yesterday's range. So we have a lower high and a higher low. We're going to say if we have a minus close, I'm going to buy tomorrow following that inside bar. I'll make $60 a trade, make some money, and nothing to write home about there though. So how about an inside day with a plus close? Oh, look at that, would you? We actually make more money. It's nothing I'd trade, but it's $101 profit per trade. So inside bars up closes look like they actually can be a little bit more profitable. Did you hear from that guy? I didn't hear from the New York Times. Of course, we wouldn't expect to hear from him, would we? No, I didn't. What do I mean by a plus close? Today's close is greater than yesterday's close. Most everything in my books is still valid, but because they're written prior to the change from going to electronic markets, you have to do some new work on them. Yes, these are buying on the open and getting out in the first profit opening. So how about outside day with an up close? We do anything there? Markets had a big run up, it closes outside of the prior bar's high, et cetera. Well, actually, you lose money. If you have an outside day with an up close, it's not profitable to be a buy the next day. How about outside day down close? Those are the days that look like disasters, and draw one of those days here. Those are days that look like they scare the heck out of everybody. Market moving along something like this, then you have a day like this. Close it down here, opened up here, took out the prior bar's high, came down here. It actually is bullish. 83% of the trades, well, look at that, $42,500 profit buying on the opening. As I said earlier, getting on the first profit open, the second stop. If you hold this trade for 3 days, it's a real money maker. So the next time you see a big outside day with a down close, you don't have to get all that bearish. They usually are close to buying opportunity. So we're starting to see, hey, there's one pattern here at least that seems to have some validity to it. Maybe there's something we can do here. Uprange day and a minus close. There's been, this is, draw this way too. So we've had a day like, this is the, I love it. We've got a day like this, and we have an uprange day like this, but it closes here below the prior day's close. Okay? This is what people call a key reversal day. It went higher, right? But it came down and closed down for the day. And they say that's how markets top and bottom. And I say people that say that didn't look at the charts. They may have written a great book, but you got to look at the charts, ladies and gentlemen. And uprange day with a minus close actually tends to be slightly bullish, not as nearly as bearish as people have said that it is. These tests are all from the E-minis, and an outside day, of course, would be a day that has a higher high and higher low on both sides of it. In other words, we made a higher high today and we made a lower low today. That's what we'd be looking for. second. I have to give some orders to my programmer here tonight. We have time. Okay. So I hope that answers your question. These patterns are actually tested on the S&Ps, but they work in all markets. In January, I'll be in Chile or in Argentina. I'll use the same patterns there. In November, I'll be in Italy. In December, I'll be in Italy. I'll use the same patterns. That's how markets trade. Because all this chart action that you see, you know what that really is? It's just human emotions. Don't read too much stuff into charts. Charts are just human emotions. Okay, how about an up range and an up close? Wow, doesn't do so well. Makes $14 a trade, no big deal. So far, we haven't seen that there's much pattern any place here. How about a down range with an up close? Well, that's irreversibly the upside. $124 a trade. It's like, what are we doing all this for? Is this getting any shooting star? I don't know where a shooting star is, guys. A shooting star is something you see at night. Just look at open, high, low, close. For purpose of your trade, this open means the opening at 6 p.m. Eastern Standard Time for my trade. Oh, look at this. Downrange day with a minus close, $55,000 per trade. Suddenly, we found a pattern that is producing some profits. Downrange day with a minus close. We have a building block. What if we have a downrange day and the close is less than the prior day's low? Whoa, 82% winner is $52,000, $160 profit per trade. So I better diagram this out for you, what that's going to look like when you see it. So here's a day, and here's a downrange day, right? Because we have a lower high, we have a lower low. Now the close this day could occur here. Say prior day's close here. Or it could occur here. In this example, I'm saying that if the close is less than this low, this close is less than this low, that sets up a pretty strong buying opportunity for us. Do I need any of your courses? Of course you do. Buy them all. No, you don't. You know, if you're making money trading anybody's stuff, you don't need my courses. If you're making money doing what you're doing, don't spend money with all these supposed gurus. Just keep doing what you're doing. Okay, so that's interesting. Now we have a trade that seems to have some more profit opportunity for us, a particular pattern. What about that close is greater than the low, the prior day's low? Well, $150 a trade, and the prior one, slide, go back. So here's a starting point to a trade. We have a downrange day, and the close is greater than the opening. We don't have much of anything. We have two consecutive downrange and down close days. Now I hope I get your attention. $265 per trade. So far, we haven't seen much of anything really. But we know that down ranges tend to set up better buy points. So if we have two consecutive down ranges, at a range like this. So I have a down range, one down range, two down ranges. I've got two consecutive down ranges, and they're both down closes. This is lower than the prior close. This is lower than the prior close. Now I've got 82% accuracy and doing $265 per trade. Don't talk to me about candles, guys. I don't know what a candle is. A candle you put on a birthday cake. I'm an old man. Open, high, low, close chart. That's all that I know, okay? So that actually sets up a really good trading pattern for us. We do more with it? Yeah. You're now going to learn a really important lesson on your charts. Yes. I'll going to my next chart, so bear with me a second here. Okay, now we've done a little something different. I have two consecutive downrange and down close days, just like we just saw. but now we go to $440 per trade. Remember where we were before? My charts or something. We're $265 per trade. And we can take that up to $440 per trade. How can we do it? I'll show you how we can do it. And what I'm showing you here, it's going to work on any market. I don't care what the market is. It could be palm oil in Malaysia. This next is how we're able to take that up so much higher. What's the difference? The difference is the low to close is critical in a market. If I look at the close to today's low versus yesterday's close to today's low, in this example, I see I have a larger space. In other words, more buying came in today. Yeah, I'm down for the day. I have a down range here. I have a down range here. I have down closes, but my buying coming in from the low to the close bigger than the prior day. Whereas in this example, down range, down close, the same thing, but I did not get as much buying low to close today as I did low to close prior day. So we still have not seen buyers coming into this marketplace. In this example, we did see buyers coming into this marketplace. That sets up this pattern of $440 per trade. 2 consecutive down range, down close days. The only difference is we're going to put in a criteria that today's down range, down close day must have a larger close minus the opening than the prior day. I'm going to use the close minus the low. You could use bailout, sure, just any short-term exit. My stop on these trades, remember, is always a dollar stop loss, like I said when we started this presentation. But here's a real insight into the market very few people are aware of, is you need to look at the buying that came into the market today. And when we've seen an abatement of selling pressures, in other words, there's a lot of selling here. We don't have as much selling today as we did yesterday. Yeah, you can use this pattern on everything. This is how markets operate, guys and gals. I started doing this stuff with Tom DeMark on stocks way back in the 1960s. This is how markets actually work. So a starting point to a trade, if the close minus low is greater than close 1 minus low 1, in other words, we're starting to see close minus the low today is less than the prior close. We haven't seen buying come into the market. Only $25,000 per trade. Not as good, is it? If we have close greater than the low, that distance is greater than yesterday's close minus the low. And we have 2 consecutive down range, down close days in the S&Ps. We can buy all days except Friday. And you have something you're not getting. You have 92% winning trades, $650 per trade. There's a question. Marlene says, you're only getting 5 points on a trade, but your stop loss is bigger than your profit potential can be. But that's how we're able to arrive at the 90% accuracy. My risk reward ratios are not the best in the world, but my accuracy is way up there. As you can see, 92%. Most of I think our actual trading system that we trade in TradeStation, I'll bring it up right now and see our accuracy for the year has been 90-something%, which is pretty unusual, isn't it? That type of accuracy. So the high accuracy comes from a larger stop, large accuracy. So maybe that explains it. Is this all based on longs? Yeah, as I said earlier, so far we're just looking at longs in the marketplace. So there's a nice trade for you. You put this one down, you can trade this. We have a close less than the prior day's low. In fact, if you look at what happened, the way this market bottomed, we had a down range, down close day, inside bar, and none of the down range close. But we had a higher close minus the low than we did on the day prior to the inside bar and the market bottomed. So this pattern I just showed you is a really valuable pattern. next slide here. Okay, what if we have two consecutive up closes, up range study? I wanted to look at this. We have two up closes. But in one of those consecutive up closes, the high minus the close is less than the prior high minus the close. Wow, we don't do very well, do we? But here, if the high minus the close is greater than the prior high minus the close, we do a whole lot better. When you explain what you look at the open, I look at the opening at 6 o'clock opening, the opening price, Eastern Standard Time, at least for most of the markets that I trade. So these ranges that you probably haven't been looking at, the distance from the high to the close or the low to the close, are actually telling us when buyers and sellers are coming into the marketplace. And that can be used as a measurement to let us know if we want to take a trade or not. Get another chart to come on here. So the opposite of what we just saw in that buy setup works for the sell setup. There we go. Best setups, and look for buying coming into the marketplace. Outside day down closes and downrange down close days are the best setups for buys. And look for buying coming into the market to confirm that we want to take the trade. And it looks like we have a delay in getting our slides to change here. Getting into a trade. Is there truth about turnaround Tuesday? When I started trading the markets in 1962, one of the rumors was that markets turn around on Tuesday. So that's been around a long time. You know, you should really investigate some of these old wives' tales, see if they're true or they're not true. Is there truth to that rumor? Well, it's easy to test. So I did a test in the S&P stock market. If today's close and less than yesterday's close, we're going to buy on Monday and make $20,000. Buy on Tuesday, turn around Tuesday, you make more money, $30,000. That same strategy doesn't work very well for Wednesdays or Thursdays, and it does make money on Friday. So can you use these techniques in the forex market? Sure, you might have to twist them a little bit, but yeah, the same patterns work at all markets because all markets are just a reflection of human emotion. There's no mysticism to the markets. You think about it. Markets, prices, charts you guys and gals are looking at, all that is how people emotionally responded during a day's trading session. That's all this stuff is. No magic to this stuff. So we know stocks usually turn around on Tuesday. So what if we buy on Tuesday? Well, we could test buying on Tuesday for up range, down range, inside, outside days, right? Just like we did earlier. We know that markets tend to bottom on Tuesdays. I first learned that in 1962, way before a lot of you were even born, let alone started trading. So let's test that. Can we find out anything? Yes, if we have an up range and a minus close, we're going to buy on Tuesday and we don't do very well. Up range with a minus close, if that's our setup pattern, we don't do well at all. Bad on Tuesday. We have an up range and up close. So Monday closed up for the day and it's an up range bar. We make $120 a trade. That ain't so hot either. What if we have a down range with an up close? Well, that doesn't do so well. It actually loses money. Down range up close. That's the supposed key reversal. It's supposed to be so bullish. Actually, it isn't. So how about a down range, down close? Monday's a down range, down close. 92% accuracy, $72,000, $480 profit per trade. Wow. Now we got a trade, don't we? So every Monday, what you want to do is say, hey, did prices close up or down for the day? Did I have a down range, down close on Monday? And if so, I have a real bias to be a buyer on Tuesday. You day traders, that's going to be a nice trading opportunity for you, and you know the potential direction to the upside, right? And for an old man position trader like me, I always wait for these things. I know I have a huge bias to enter the market on those particular types of days. Having problems understand opens and closes now that it's electronic. The old way was 9:30, 4:30. So the opens that I'm using is 6 o'clock night. The S&P is open at 6 o'clock Eastern Standard Time. I'm using that as where the day begins today on Monday, Tuesday, or Wednesday's market. And the close at 4:15, 4 in the afternoon tomorrow will be the close of the Wednesday bar, if that helps. 150 trades per year, no. Marlene, those are 150 trades in the last 10 years, so it doesn't trade a lot. That's the problem, right? So we have to have more than just one pattern to give you today, but that's a great pattern. Here's a neat little Tuesday trade. If tomorrow is the first trading day of the month, and tomorrow was Tuesday buy, 34 trades, 32 winners, 2002 forward, there's not been a losing trade. Does trade count equal lot or contract size? Remember, in the S&Ps, unlike stock, we're just buying one contract. All the results that I'm showing here, the assumption of buying just one contract, no money management, nothing like that at all. Are you coming to Singapore, Malay? I may. I'm trying to do something in Japan that would come on over to Singapore. I hope so. And if you're getting confused, just let me know what's confusing. So we've known that prices tend to rally at the first of the month in the stock market. That's another old adage that Art Merrill wrote about in the 1960s and 70s. That one's been kicked all over the street for a long time period. But I thought, well, what if we combine the first of the month we tend to rally? What if that's on a Tuesday? We get any double duty impact there? You know, clearly we do, don't we? 2002 forward would not have a losing trade yet. These trades are for the S&Ps, yeah. But the ideas I'm presenting here, you can take into other markets. I do into other markets. The nice thing about trading the stock market is that there's so many things that affect stock prices. You know, hogs and cattle are only affected by a couple of things, but we have interest rates, we have inflation numbers. Stocks are a lot more predictable because, you think about it, in a sense, stocks are an average of Dow Jones, an average of 30 stocks. Is it easier to predict one person's behavior in a crowd or to predict 30 people's behavior in a crowd? Obviously, you can get a pretty good idea of what 30 people are going to do if you do a survey in a sample called polling at elections, right? But just one individual, you don't know for sure what they're going to do. So an average is a whole lot better, easier to predict than just one individual stock. Tough to make money when you have to be out the same day. Yeah, it is, and that's why I don't get in and out the same day unless I'm stopped out. I'm buying today, and I hopefully get out in a couple of days. Time is my ally. I need time. So here's a whole new concept in trading, exogenous trading. There's more stuff on this on our website, ireallytrade.com as well, and we're going to be doing a stock seminar, investing seminar, so you might want to go there and find out more about that. But here's a really interesting breakthrough in trading that I don't think you've been exposed to before. Exogenous means something outside of some other thing. Bonds and stocks have a love-hate affair, so I can actually use bonds to give me signals in the stock market. If bonds have been down X days in a row, stocks are probably going to rally. If bonds have been running straight up, it probably means there's going to be a flight to capital and stock will decline. I don't even have to look at stock prices to get a signal for the stock market. I can use the bond market to give me a signal for the stock market. That's exogenous trading. Stocks don't have the same trading period though. So yes, the stocks trade very similar. Yes. There's gold influenced stock. Oh yeah, there's a relationship between gold and stock that's very important. The lumber influence a myth. Now this is one of those old wives' tales. You know, I used to trade plywood, and we don't trade that any longer. Now we trade lumber. But there's always an old adage that lumber led stock market. Led it by 10 days, maybe something like that. But for some reason, that adage, I think I first heard about that maybe like 72, 73, something like that, in the 70s. Lumber was a leading indicator of stock prices. No, that's pretty interesting. Um, and probably to an extent, but not as much. I want some real strong thing. Lumber influence in there. Well, I did a simple test. If lumber is greater today than it was 7 days ago, and the E-minis are lower than yesterday, get your attention. 194 trades, 90% accuracy, $55,000. All the rule is E-minis are down today. Lumber is higher than it was 7 days ago. Remember, lumber in theory is a predictor of short-term directions in the market. What do you think? It is. By now, you're probably asking the question, could we make that better? What if lumber is lower than 7 days ago? Sorry, it's greater than 7 days ago, and the E-minis are lower than yesterday? Well, we're going to take that trade on Tuesdays, because we know about turnaround Tuesdays, right? Wow, 97% accuracy, $433 a trade. It's also not bad on money. What is lumber? Lumber is a commodity contract that we trade. You know, we trade wheat, cattle, used to trade pork bellies, gold, copper. Well, lumber is another contract. We trade lumber, random lengths of lumber. You know, lumber you build houses with. So gentlemen prefer bonds, especially on Tuesday. Tuesday trade set up by Monday. If E-minis are lower than 7 days ago and bonds are greater than 11 days ago, and we have our downrange close, $700 per trade, 91% accuracy. So we're using these exogenous things to confirm and give us a trade. Totally different than the way most of you are looking at a candlestick formation or a stupid moving average or a Williams percent or oscillator, whatever it is. Those are things that are all part of price action. You're looking at price to predict price. But I want to step outside that and go, well, let's see. Bonds predict stocks. We know that. Lumber predicts stocks. I've just shown that to you. So the idea of exogenous trading is to reach out and find something that is predictable in the stock market so our trades are more valid, are better trades. That's what exogenous trading is all about. For bonds on Tuesdays and Wednesdays. Here we're doing $700 a trade, 97% accuracy. Tuesday and Wednesday trade is set up by down range and close less than low one, and the E-minis are lower than 3 days ago, and bonds are higher than yesterday. So we have that little down range, down close thing that we're looking for. We know that tends to be very bullish, right? And bonds are greater than yesterday. That's going to be a trade setup. How do you feel the relationship between stocks and bonds has changed in the last 5-6 years? I don't think that it has. Ivan, how about the Canadian dollar? You mean as a trading vehicle? Actually got a bicycle of the Canadian dollar 2 days ago. So short term, I can just tell you what I think. I don't trade it a lot myself. I'll tell you why I don't. I like to trade the big markets because I'm dealing with size. Not a new 100, 200 contracts in these markets. And it's a little more difficult to do that, say, in orange juice or crude oil, not coffee, than it is in the big markets. Crude oil, bonds, S&Ps. I can get in and out of that without much of a problem. What does the $2,700 mean? That was the average profit. So we made 39 trades and made $27,000. 97% accuracy. I run all the tests myself. You've always said you're buying. Are you ever shorting? Yeah, I do short a little bit, but for the most part, it's easier, especially for you guys and gals just beginning to work the long side of the markets. Instead at the first, it's a lot easier to find buying opportunities that last and selling opportunities that last. I don't know why. It's something I first noticed in 1984, 85, 95, 2005, 2015. It's just the way the markets are. Maybe that's just I'm not smart enough to figure out the great selling opportunities. I've got some good selling opportunities. They're just fewer and farther between. Buys tend to be a lot more responsible, reliable. So the lesson is here, down ranges with down closes set up the best buying opportunities. So we have an advantage in the market. You now have an advantage in the marketplace you did not have 45 minutes ago. Now you know a reliable pattern that you can start to take advantage of. Does range matters? Yes, range, so the type of day that was just completed really matters. Down range, down close are the best setups. We saw earlier, we only have an inside day, outside day, up range, or down range. We have 4 things that can happen today. And the one that is the most bullish is going to be the down range, down close day. Is this work on 5-minute bars? Maybe to an extent, but I would seriously suggest you stop trading 5-minute bars. They don't work. The only bars for my money that work anymore are kick or volume bars, because a lot of good trading takes place during the night session. But you need to equalize it. 5 minutes at night doesn't equal 5 minutes during the after session. So what I'm trading, if I want to go down that time scale, 10,000 kick chart or 10,000 share chart, that equalizes activity at night with activity during the day. It makes a huge difference. This is not buying a falling knife. Well, we'll get into that. Bear with me. Here's the ideal E-mini pattern, by the way. I did some interesting tests on this. This is what most of us like to do. We like to a market an uptrend, a market's pulled back. Well, is there an ideal pattern of how big this trend is and how long this correction has taken place? Yeah, there is. The ideal pattern like that is if today's close was less than 8 days ago and greater than 15 days ago. Just buying on the opening, it doesn't matter anything else. Getting out first profit, opening a protected stop, 89% winner, $55,000. So here's the pattern again. So we're lower than 8 days ago, but we're higher here than 15 days ago. So we've had an up move and a pullback. And I wanted to know about, is there one particular time period that seems to be the best? This was very interesting that it came back with 8 because years ago, I developed a system for a guy on the floor of the New York Stock Exchange, a specialist. He went on to become one of the governors in the exchange. And the key point in that system was a 8-day low. Really interesting. With the studies, look at that 8-day close low is a really important thing. There's the ideal bullish pattern. Please answer Lori on exit strategy. Well, we don't let her, she was asking, but my exit strategy and all these examples I've talked about here, just like I talked about in the third PowerPoint presentation, I'm going to exit on the first profitable opening or a dollar stop loss. Are there better exit strategies? Absolutely, you bet. But for a simple one, it's effective, that all of you can follow, you can program it pretty easily. That's what it is. So, Gonzalo, I hope that answers your question. If not, please let me know. Okay, well, that's going to wrap it up. But, I'm going to show you one more thing because there was a question that came in, and it's about catching a falling dagger. So I'm going to show you something. Bear with me on this. People like to try to buy markets that are coming down like this, right? And they're looking for a low simply because the market's come down. But you've got to be careful because this market can keep coming down. Is there any technique I can teach you that will avoid that for you? Yes, there is, and I'd like to show you what it is. If the market's coming down like this, like this, this, let me do something like this, this. I am looking at today's high versus being in the range of the high of the last 3 or 4 bars ago. Notice this high is in the range. So I've stopped the falling knife. But if the market's coming down like this and this and this, this day's high is not in the range 3 days ago, is it? So that's a falling dagger situation. I don't want to touch that at all. Most people want to rush in and buy here. So the way to know if that falling dagger has stopped falling is today's high in the range of the last 3 or 4 days? So the market's coming down like this. I'm still not interested in buying. Maybe the market does this. Market does this. It's still down. Looks bad for the day. But this high is in the range 3 days ago. So I know we've stopped this falling, this free fall in the marketplace. So I look for that as a way of stopping that. Okay, questions have come in. Oh my gosh, there's questions faster than I can answer them. Can you combine these setups into one? Yeah, I use the system that we have in TradeStation is a combination of a lot of things, just like we've been talking about. There's maybe 10 different patterns like that in there in the system that we have. I think the system sold out. It's not open at this point. Nobody's only take like 40 people, and everybody's been happy with it. So, there's no openings on it. Are you doing any webinars this year? Yeah, go to our website, ireallytrade.com, and get more details on whatever else Larry's going to be doing. You require all 3 full markets to sync? No. Yeah, volley, chili trend stop is a good stop. Should I short the E-minis this week? I wouldn't short the E-minis right now. Today's low is higher than the high 3 days ago. So we're in the free fall, except to the upside, aren't we? Are you really going to retire? Absolutely, you bet. You guys know how much pressure there's been for trading for 54 years now? You know, and emails, it takes me a couple hours every day just to email everybody. And I appreciate your support now, but you know, at some point, I'm not a young chicken anymore, guys and gals. I'll still be around. You'll still have me around a little bit. I'll still do Larry TV, my annual forecast, because that's a real passion for me. But the active, intense stuff, yeah, you know, it's time. Joe Granville died a year ago. Marty's wife died. These guys, listen. So, yeah, I guess. Well, I hope I've given you some ideas to think about today, some new perspective on the markets, understanding there are only 4 possible opportunities that can exist for tomorrow based on today's price action, and which ones set up the most reliable signals for us the next day. That we can focus on things like Tuesdays, we can look at buying coming into the marketplaces. Hopefully that's some new insight that's going to help you in your trading, because that's what I'm really all about, trying to help you guys along the path I've been on. My path is certainly not straight up, it's rocky too. It's all about learning. This is not a business where it matters who you know. It's a matter of what you know in this business. And I hope today I will help you know just a little bit more. I'd like to thank everybody very much for being here. TradeStation crew, my gosh, how they've been great to me. Thank you so much. Stanley for being here today, and Frederick for helping me like you guys have. You guys are great. Thank you. And thank you for traders, because we're all trying to learn stuff. We're on the same ship here. So everybody, thank you very much. Always good luck and good trading. Hope to see you all path soon.
Larry, we want to thank you. That was outstanding. And I certainly want to thank everyone for attending the vociferous questions and challenging questions, and Larry's patience with some of the technical issues, and certainly that great content. We will turn around this archive in a day or two and get it posted. I will again put the locations for that post, Spotlight on Archives, our YouTube channel. TradeStation users can get our new Video Station app. Oops, I just clicked the wrong spot. Here you go. And we will get that turned around. My thanks again to everyone for attending, and of course my special thanks to Larry Williams. Have a good day, everyone.
Good night.